In a world increasingly focused on green energy, how does a thermal coal company plan not just to survive, but to triple its size? Today, we're looking at Singapore-listed Geo Energy Resources, a company making a massive, high-stakes bet that its future depends not on the price of coal, but on a single, transformative infrastructure project. They are attempting to fundamentally rewire their business from the ground up, and the outcome is anything but certain. Disclaimer: this video is created purely for educational purposes only. It is not financial advice and should not be considered as a recommendation to buy, sell, or hold any investment. Please conduct your own research or consult a licensed financial advisor before making investment decisions. Let's start with the big picture for the global coal market. According to the International Energy Agency, global coal demand hit an all-time high in 2024, but it's expected to plateau and then slightly decline through 2026. This creates a zero-sum game. For one company to grow, it has to take market share directly from its competitors. Price increases can't be relied on to lift all boats. This is the challenging environment where Geo Energy is making its move. The company has a bold and ambitious plan to increase its annual production capacity from a stable 7.8 million tons to 25 million tons. This isn't a minor adjustment. It's a more than threefold increase in output. This strategy was set in motion by the 2023 acquisition of a controlling stake in PT Golden Eagle Energy, which gave Geo Energy the vast resource base needed to even attempt such a massive expansion. But volume is only half the story. The true centerpiece of this entire strategy is the $150 million MBJ Integrated Infrastructure Project. So, what is it? It's a dedicated 92-kilometer hauling road and an associated jetty in Indonesia, scheduled for completion by the first half of 2026. This project is designed to do two things. First, it enables the massive increase in production volume, but more importantly, it aims to slash unit transportation costs by over $10 per ton. Now, that $10 figure might not sound like much, but let's put it in perspective. Geo Energy's earnings before interest, taxes, depreciation, and amortization, or EBITDA, was severely compressed to just under $31 million in fiscal year 2024. If the company successfully ramps up production to 25 million tons a year, a $10 per ton cost saving translates directly into an incremental $250 million in annual EBITDA. That single project has the potential to fundamentally transform the company's entire profitability structure, making it far more resilient to volatile coal prices. Of course, a project of this scale requires serious capital, and this is where management's past decisions become critical. Over the last 5 years, Geo Energy has been proactively strengthening its balance sheet. It has cut its debt-to-equity ratio almost in half, from nearly 69% down to about 38%. They effectively used the profits from the last commodity boom to de-risk the company, giving them the financial stability and capacity to fund this major expansion without taking on excessive new debt. Now, how does the market view this ambitious plan? This is where things get interesting. If you look at the company's valuation, you see a bit of a puzzle. On an asset basis, its price-to-book ratio is 1.1, which is right in line with its industry peers. But on an earnings basis, its price-to-earnings, or PE ratio, is nearly 17, substantially higher than the peer average of around 11. This tells us that the market is already anticipating the company's future success. Investors are paying a premium today not for the company's depressed current earnings, but for the massive earnings recovery they expect to see after the MBJ project is completed and the cost savings kick in. The potential upside has to a large extent already been priced into the stock. This brings us to the most important part of our analysis: the risks. When a company's valuation is built on future promises, the stakes are incredibly high. The number one risk is execution. The entire investment thesis hinges on the MBJ project being completed on time by the first half of 2026 and within budget. Any significant delays or cost overruns could cause a rapid loss of investor confidence and seriously damage the stock's premium valuation. The second major risk is commodity price. While the project is designed to protect against price volatility, the company is vulnerable right now. Its earnings are depressed, and a key metric, the interest coverage ratio, is low, at just 2.5 times EBIT. This means there isn't a large financial buffer. If thermal coal prices were to fall significantly further before the cost savings are realized, the company could face serious financial pressure. Finally, there are regulatory risks. Operating in Indonesia means navigating policies like the domestic market obligation, which requires a portion of coal to be sold locally, potentially at capped prices. Furthermore, the rise of ESG pressures and the potential for new carbon taxes could introduce new costs that might eat into the project's anticipated $10 per ton savings. So, given these factors, we can imagine a few different scenarios. In a base case, the project is executed successfully. The 25 million ton capacity is reached and the cost savings are fully realized, which would justify the current market optimism. However, in a bear case, the project stalls, costs overrun, and coal prices deflate. In that scenario, the company's thin financial cushion would become a major problem, and there could be significant downside risk. And in a bull case, the project finishes ahead of schedule, cost savings are even greater than expected, and a temporary bump in coal prices occurs. This combination could unlock upside well beyond current expectations. So, to summarize, what is the key takeaway from all of this? Geo Energy Resources is in the middle of a high-risk, high-reward transformation. The company's future is not tethered to the hope of a new coal price boom. Instead, it rests almost entirely on management's ability to execute one of the most critical projects in its history. The potential reward is a complete operational and financial reinvention, creating a high-volume, low-cost producer that is structurally more profitable and defensible than its peers. The primary risk is concentrated in the execution of the MBJ Infrastructure Project. The market is watching closely, and the clock is ticking towards that first half 2026 completion date. Any signs of a delay will be a critical signal for investors. If you found this analysis helpful, please consider liking this video, sharing it, and subscribing to our channel for more deep dives into the companies and trends shaping our markets. Thanks for watching, and we'll see you in the next video.